Thanks for your company for the monthly wrap, covering what shook the markets this month and what to expect going forward. Well, November was a record-breaking month, and it's been a record-breaking year for the Aussie share market, with the benchmark ASX 200 closing at a brand new all-time high on Thursday, 6,851 points. Finally, we did it. The last time that we saw the ASX 200 and the All Ords touch these levels was about 4 months ago on the 30th of July. Looking at November, we're up 2.6%, well and truly erasing those negative October returns. And if you looked at the yearly picture as well, it's much rosier compared to last year's loss of about 7%. Both the ASX 200 and the broader All Ordinaries are up 21% year to date. Including dividends, it's sweeter than that, 26%. But if we think about the market and where it's headed and what's on the cards, it's likely to gain momentum and push higher for reasons we'll touch on later. So what was in the secret sauce for November? Well, the tech sector rose the most, about 11%, recovering from their worst performing post in October. Looking at the other sectors, staples and healthcare were the next best sectors, up about 8% each in the month, continuing to shine. These two sectors, staples and healthcare, are likely to continue to outperform next year, as of course we grapple with those headwinds, the lower for longer interest rates, as well as weaker economic growth globally. And people, after all, still need to eat, and they still have healthcare needs, regardless of what's going on. So looking at the worst performing sector, it was financials, down 2.8%, weighed down by the fact that the Bank of Queensland, ANZ, Macquarie and Westpac all went ex-dividend. And bank stocks usually see selling when they trade ex-dividend, as they transfer the right of the dividend to shareholders. But adding to that, we had a bevy of corporate news. Westpac shares hit a 9-month low on the back of those AUSTRAC allegations, and then of course we learned that their CEO will step down. The Bank of Queensland shares hit a multi-year low after launching a $275 million capital raise, but the Bank of Queensland should bounce up in December, as the market is now saying their shares are undervalued at $7.75. If we pick out what two brokers are saying, Credit Suisse and Goldman Sachs expect the Bank of Queensland shares to move up to $8.65 or thereabouts in a year. The financial sector itself should somewhat bounce back up in December as investors buy back into banks after the ex-dividend period has well and truly passed. Moving to monthly darlings, Caltex shares pumped up the most, 26.5%. The bulk of those gains are from this week, but we think there could be more room for Caltex shares to run. On Monday, we saw Caltex announce plans to spin off their petrol station sites, and that pushed their shares 7% higher. 12 hours later, the company was forced to announce that $8.6 billion cash takeover offer from the Canadian convenience retailer called ACT. The offer also includes the potential of a special dividend. And all this news on that day sent its shares to an almost 2-year high, popping up $4 or 13% to $33.79. Why? Well, the takeover offer was at a price that's 16% higher than the day before's closing price. And we think there's a sweeter deal on the horizon from ACT. Well, why? If you look at the enterprise value for Caltex, the enterprise value compared to their earnings or EBITDA ratio, that valuation stands at 8.7 times. What this means is it's undervalued in comparison to its peers. If we take Viva Energy, for example, that's trading at an enterprise value or earnings or EBITDA ratio of higher 9.3 times. Once, of course, that sweetened deal comes. Whenever that happens, we think the Foreign Investment Review Board will give the nod, ticking the deal to go ahead, as it did for EG Group, allowing that company to snap up Woolies fuel business for $1.7 billion. The second best performer looking at the month was NRW, clocking up 25.8%, hitting a 6-month high after they were earmarked as the preferred bidder to buy the mining and construction contractor called BGC Contracting, which is likely to drive up the company's earnings per share. Moving to the larger flows in the market, let's get ETF specific. And what we're talking about now is exchange traded funds flows and where the market has been investing in terms of key themes and sectors. Well, global equities took the main stage again, seeing the most flows in October in terms of exchange traded funds as investors seek out returns from the world's largest companies. 456 mil was tucked into international equity ETFs. Investors also forking out $360 million into Aussie fixed interest ETFs, using fixed interest to diversify their portfolios or hedge their bets, of course, because the global economy is thawing out. And year on year, the same themes played out too. Investors fork out a massive $3.7 billion into global equities, proving investors are typically using ETFs to get their international exposure. Now let's get really ETFing specific. People are also using ETFs to outsource some of their Aussie share market investing, but they're also hunting for the cheapest fees in doing so, which is why we can see Vanguard's Aussie share ETF see the most inflows year on year as they slash their fees or their MER to 0.1%, while Spider's S&P ASX 200 fund saw the most outflows as it's more expensive. And if you stacked up their performance, Vanguard's also outperformed Spider. Vanguard's ETF returned 19% and Spider's returned 18.3%. And that's some food for thought. For more on that, check out Bell Potter's ETF report. Now what to watch next week and going forward. Let's start with the economics for next week. On Tuesday, US manufacturing levels are expected to have improved in November. Well, the data from the prior reading was still in contractionary phase for manufacturing at a level of 48.3, and it's forecast to strengthen to 49.1. On Wednesday in Australia, Aussie GDP is expected to grow from their prior reading of 1.4%, and GDP growth year on year is tipped to grow to 1.8%. On Friday in the US, the balance of trade is out for October, and this will be watched closely as the market really comes to grips with how much a trade war has taken a toll on United States imports and exports. What's on the Santa sleigh for equity markets? Well, markets around the globe are set to see the Santa rally in December, with macro factors also supporting the cause too. Interest rates, of course, fresh record lows. The global economy is beginning to find its feet, while property prices are pushing higher. Locally, property prices have grown by about 1% per month over the last quarter, and if this continues, property prices are expected to hit a new record in just 6 months. That's according to CoreLogic. So what will we likely see? Well, non-discretionary stocks, including retailers, are likely to get a kick because of the wealth effect, while the lower Australian dollar will also likely boost the revenue lines of those companies that export. Compounding on that are the cold hard facts that December and January have been the strongest months for equities since 1985. On average, if we dive into the figures, the Aussie share market has gained 2.6%, while US equities have gained 2.5% over the 2 months. Interestingly, the S&P 500 alone has had its best monthly returns in December. On average, it's gained 1.6%, rising 80% of the time since World War II. And lastly, the trade war. Well, the trade war is expected to ease. Likely, phase 1 will be inked before New Year's Eve, with Trump likely to trump up a deal given that he's up for election in the new year. Thanks for your company. Have a great afternoon.